10-cent increment. A lot of times you can lay that out and you'll see that pattern play out. It's 10 cents. We'll try another 10 cents, see what happens. And then up here, let's make this 40 cents. So the first thing that I would point out is that there was a setup on the weekly chart right away. We broke through this support level here. This was a rectangle that measured 10 cents. So breaking down below the bottom of it, your target would be 10 cents from the breakout. And actually, really, the support extended down to 9 cents. So you could have aimed for 9 cents, but I think 10 cents was good enough. Your stop loss would have gone right here, halfway through the rectangle, like we have spoken about previously. Now let's go to the daily chart. Notice this stair-stepping pattern. Now remember, 20 cents was an area of previous support. So when we did break out, it makes sense that that would have been the initial target. Now let's see if we can find the setup. Let's go ahead and put volume on. So the breakout here was on high volume. That should have got your attention. Notice how the volume was picking up along the way. I'm willing to bet that this Bollinger Band breakout squeeze trade showed up, and there it is right there. That candlestick breaking above 10 cents meant something. Volume picked up that day, and then it just took off. Made sense that 20 cents was where we ended up. We were outside the Bollinger Band. We formed a shooting star. If you are a trader who's willing to take a lot of risk, that's a sell signal. If you are a little bit more conservative, that's not a sell signal. That's just a signal to either take profit or move your stop loss up. For myself, probably would have taken profit. Then you had this massive, it's the exact same trade, but a much bigger candlestick. And that tells you need to be thinking long again. Shooting star, that's a negative turn of events. Hammer, that showed positivity. And on a hammer, you put a stop loss on the bottom of the candlestick when you break the top of it. You probably sweated this out for a while, but you never came anywhere near your stop loss. You would have had to have a 9-cent stop loss. And at one point, you were down roughly 6 cents. So, it might have been uncomfortable for a minute. But when you set up on this, that's your target, and you ended up hitting that. So as we go down into the past here is an interesting setup. Massive volume breaks through the Bollinger Band, and then we form this big red candlestick, wiping this candlestick out, essentially turning it into a hanging man. That's not the perfect hanging man, but tells you the same story. You sell on a breakdown below there. You see some support there. If you are conservative, remember I talked about flipping at the Bollinger Band. You could break down below and then look for a sell signal there, like a failure. That certainly took off. So if you were a little bit more conservative, you could put a stop loss on the other side of this and then watched it rip. So let me get rid of the Bollinger Band. And I will put exponential moving averages. Well, no, I'll put simple moving averages for now. And let's make this a red 50. This probably, I don't know that we have enough history on this chart, quite frankly, to make this as useful, the 200-day. You could see that there was a golden cross and then a death cross. So it was kind of whippy, but the death cross certainly worked out. Notice how the market on volume broke above the 50-day EMA, kind of danced along there, and then on volume rose again. Once you break back above the 200-day EMA, that is a sign that momentum is starting to pick up. I mean, once you break above the 50-day EMA, that is as well. That's shorter term, but that's longer term momentum coming into play. Notice this hammer-like candlestick right here, right at previous support at 6 cents and the 200-day EMA. Furthermore, I'd also point out that the pullback right there with the 200-day EMA, previous support, hammer-shaped candlestick, 50% Fibonacci retracement level, 200-day hammer, 50% fib with an uptrend, previous support. That's at least 4 reasons to go long. You put your stop loss on the other side of the candlestick, maybe a couple cents down. So where's your target? Well, your target minimum is going to be up here to capture the Fibonacci retracement move. So that's your minimum target. And eyeballing this without measuring it, it looks like it's about a 3.5 to 1 target. As long as you have good risk to reward ratios, over the longer term, you should do quite well. It is when you don't, when you take these where you're risking 5 cents to pick up 3, you do that enough, you'll end up losing money. But if you are diligent about your risk to reward, you certainly have a much better chance of making money longer term. That's why you wait for a move like this. You wait for it to pull back, because if you buy it up here, you're just now back in the green, as it were. Your stop loss would have to be here on a break above this candlestick. And it's not that you can't do it. It's just that you better be prepared to sit on it for months. So that's why we don't trade like that. Plenty of other things to look at on this chart as I glance through it. So there is a triangle. So the question is, we did pull back. So did we get our measured move? And yes, right to the penny almost. So that's definitely worth paying attention to. Now, you would have had your stop loss here. Would you have moved to break even on the hope of it going farther? Maybe. You may have got stopped out of break even, but clearly the signal was there. Stellar moves, it does trend nicely, but it's another one of these kind of thin markets. So like on the hourly chart, for example, you are going to struggle sometimes to find setups that are as clean. I mean, I do see one here. That's a massive symmetric triangle. And now that we have broken higher, and in fact, we just tagged that a few hours before at 44 cents. So nice setup, really. You could also change this is exponent. That's a simple. So let's do the moving average exponential. There we go. So let's make this 20. Let's make this black. Okay, so yeah, I mean, looking at this triangle, you did have the moving averages kind of twist here and there, and then we opened back up on volume on a breakout. So you could have even taken your time getting in there. The point on this is that these technical analysis bits and pieces here do work, but like on a shorter time frame on these thinner markets, these smaller cryptos, you typically need to give it a little bit more room. Now, on a daily chart, it's not too bad, but like on an hourly chart, or, even if you go down to like 15-minute chart, the setups aren't as clean because you see all this choppy jaggedness. There's a lot of back and forth here. So do keep that in mind. It's a little harder to day trade some of these smaller cryptos, but you can see that those setups all did pay off. The one exception might be that triangle I showed that may have taken you out at break even. Once you hit the target, it just comes down to whether or not you claimed your profits right away or took half off, however